Welcome to this explainer. Okay, today we're tackling a fascinating question. Is China's massive integrated energy company, PetroChina, a massively undervalued cheap energy giant, or is it just a risky bet on commodity prices? You see, oil prices can plunge and commodity profits can absolutely collapse, yet somehow China's largest oil and gas companies can still pump out enormous amounts of cash flow. Look, this isn't an AI stock, it's not some biotech moonshot. We're talking about a massive, established energy behemoth sitting right on top of one of the world's most critical resources.
And honestly, that sets up the ultimate tension for us as investors, right? When you're looking at energy companies, which play by completely different rules than your typical tech or consumer stocks, you have to ask a hard question. Because PetroChina's core product is completely dictated by the whims of global markets, are we actually investing in a high-value, durable business, or are we just placing a casino bet on where the price of oil goes next?
So, to figure that out, we're going to build the ultimate investor dashboard today. We'll hit 5 key steps: meet the energy giant, the revenue machine, the commodity trap, wildcards and real risks, and finally, the final verdict.
Section 1. Meet the energy giant, understanding PetroChina's scale. Now, the absolute first thing we need to do is shatter the illusion that you can evaluate a company like this the same way you evaluate Microsoft or Coca-Cola.
You need a totally different framework here, mainly because PetroChina isn't just a simple oil producer. It's a sprawling, diversified ecosystem. They're out there exploring for oil and natural gas, sure, but they are also refining it, marketing it, churning out petrochemicals, and they're even making moves into new energy businesses. This matters a lot. It means we're dealing with a fully integrated energy system, not just a one-trick pony relying solely on pulling crude out of the dirt.
Section 2. The revenue machine. How the integrated energy system works. Let's actually look under the hood and see how all these moving parts connect to generate that massive cash flow.
If you just track the physical flow of the oil itself, it paints a really clear picture. It starts upstream, right? That's where they find and actually produce the oil and gas. Then it flows midstream for transport and processing. After that, it moves downstream where it gets refined into everyday fuels. And finally, you have the chemicals division, where those hydrocarbons are transformed into vital industrial products. It's literally a start-to-finish pipeline of revenue.
And here is why that setup is so brilliant. It acts as a natural hedge. Think of it as a built-in shock absorber. When crude prices drop, the downstream refining division actually gets a boost because their raw materials are suddenly cheaper to buy. On the flip side, if crude prices skyrocket, well, that upstream division sees profits explode. But listen, even with this internal balancing act, we can't pretend commodity prices don't drive the final bottom line. They absolutely do.
Section 3. The commodity trap. Why oil prices rule everything. So despite that awesome natural hedge we just talked about, we really need to confront the ultimate boss of PetroChina's earnings, the global oil cycle.
Just look at these two cycles side by side. It shows you exactly how a massive surge in cash flow can turn into a brutal trap for investors if crude prices suddenly tank. In a bullish environment, oil rises, revenue per barrel jumps up, cash flow spikes, and suddenly they're handing out dividends like candy. But flip to the bearish cycle. If oil drops, say, 30%, margins get instantly crushed. And this is exactly where folks get trapped. They look at a stock that seems insanely cheap based on last year's earnings, totally forgetting that those earnings came from a bullish commodity environment that is already in the rearview mirror.
You can never forget this one golden rule of energy stocks. High income potential is absolutely not guaranteed income. Energy dividends are incredibly sensitive to capital spending, what management decides to do, and of course, global commodity prices. That makes trailing price-to-earnings ratios dangerously misleading. You might see a massive, double-digit dividend yield on your screen, but if oil collapses and the company still has to spend heavily on infrastructure, that free cash flow vanishes, and suddenly that juicy dividend is on the chopping block.
So, when their next earnings report comes out, please don't just ask if they beat Wall Street's expectations. Run through this 8-point dashboard instead to check the actual pulse of the business. You want to verify that crude and gas production are stable. Check if their realized oil prices and refining margins are holding up. Keep a very close eye on capital expenditure because you want to make sure free cash flow stays strong enough to actually fund those shareholder returns while also keeping net debt manageable and capital efficiency solid. Trust me, using this checklist is 100 times more useful than just watching the stock price bounce around every day.
Section 4. Wildcards and real risks. China macroeconomics and geopolitics. Okay, we've mapped out the internal engine. Now we have to look outside the company, at the two massive external wildcards that essentially dictate PetroChina's fate.
You have to remember, PetroChina supplies the Chinese mainland, so taking a position here is just as much a bet on China's overall macroeconomic engine as it is on the price of a barrel of oil. If the Chinese economy accelerates, construction and manufacturing boom, and fuel demand goes through the roof. But if, for example, the property sector slows down, that ripples outward immediately. It hits demand for steel, machinery, and transport, all of which guzzle energy.
Furthermore, energy companies are incredibly strategic assets on the world stage. That creates unique opportunities, sure, but it also leaves investors completely exposed to a massive web of international and political risks. Think about it. U.S.-China relations, Middle East instability, shipping disruptions, surprise decisions from OPEC+, currency fluctuations, and even international sanctions. These are very real, objective factors that you have to weigh objectively and carefully. They demand a risk discount.
So let's summarize all those threats into a risk scorecard. As you can see, we're looking at a pretty clear medium-high risk profile overall. And that's driven heavily by the red zones: massive oil price volatility, heavy geopolitical risk, and significant government influence. Now, the balance sheet and dividend risks sit at a much more comfortable medium level, which is great, but those external macro factors are glowing red for a reason. You can't ignore them.
Section 5. The final verdict. Scoring the stock and setting a strategy. We have our dashboard, we know our risks, so let's finally grade PetroChina as a potential investment.
This final scorecard perfectly illustrates the tightrope walk of investing here. On one side, you have a company with 5-star strategic importance, incredibly robust physical energy assets, and absolutely top-tier dividend potential. But right next to that, you've got glaring, high-risk exposure to commodities, the Chinese economy, and geopolitics. It is literally a textbook case of massive potential reward completely tethered to massive systemic risk.
So how do we actually play this? Well, here is a framework to guide your actions. The key is to never confuse a temporary dip in oil prices with permanent damage to the business. The classic setup for a buy is usually during a broader market pullback when cash flows are actually still strong and oil is generally supportive. You don't want to go chasing the stock right after a huge rally in oil.
When we tally up everything across all those different categories, our analysis yields an overall score of 7.8 out of 10, which is solid. It tells us there is a really compelling value and income opportunity here, provided, and this is a big provided, you can actually stomach the macro volatility that comes with it.
And I think this quote perfectly distills the core takeaway of our entire explainer today. With PetroChina, the dividend is the reward, but the oil cycle is the boss. You are quite literally getting paid to absorb the wild swings of the global energy market. The cash generation can be life-changing, but make no mistake, you are never truly in the driver's seat. The commodity cycle is.
So I'm going to leave you with a question to chew on as you evaluate your own portfolio. Is the allure of that massive cash flow and high dividend yield enough to outweigh the heavy weight of those global commodity and geopolitical risks? Does a company like this actually fit your personal risk appetite? Thank you so much for joining me for this explainer, and definitely keep these frameworks handy the next time you're diving into the energy markets.